Hello guys, welcome to lesson 2 of the higher time from training series, and today we're going to talk about ipda data ranges. You can call it ipda or you can call it ipda, either works. Now what ipda stands for is interbank price delivery algorithm. So this is our topic of discussion today, which is ipda, and it stands for interbank price delivery algorithm. Alright, so and where did this vanish to? So let me type this out real quick one more time. Okay, so we have interbank price delivery algorithm. That's our topic of discussion today for higher time frame series, and we are going to delve into macros, macro analysis for price. All right, so when it comes to ipda data ranges, we have something called the quarterly shift. Now, just as an introduction into this part of the course, which is module 2, this part of the course we're not dealing with lower time frames. We're not going to deal with anything less than the daily time frame. So we're only primarily in the course going to focus on monthly, weekly, and daily time frames, and we're going to work on using these daily levels as a forecast. So my goal here is to build your understanding of higher time frame price using all the concepts and tools I will discuss throughout this series, of course. And every single day, whenever I drop a video, I'm going to do a market forecast or a market analysis using daily time frame, and then you can go in your chart and see the outcome. So I'll do a forecast every day along with the video, and then you go in your chart and do a forecast of what the daily candle did. So that builds your own understanding of how to utilize daily analysis. Okay, so when it comes to ipda data ranges, the first I want to talk about is the quarterly market shift. Now, there's something called a quarter. Okay, quarter is the span of 3 months. Okay, so every 3 to 4 months in price, there usually is a major market shift in a new direction. So this is 2023. So we're gonna delineate this for USJPY. I just decided to select this example, and you can see here this is the month of October. Okay, so between the month of October going into January, we have 3 months. You can see we had a major shift in delivery, okay, in the last quarter of 2022. All right, so again, a quarter is generally around 3 to 4 months, and usually what price does is price tends to stay on one side of the marketplace within a quarter. We had one recently with euro dollar. That's something we actually even called live. And let's go back and look at euro dollar from so get rid of all this. And that was all the way back here. Okay, so around the start of October, we started to look for bullishness in euro dollar, and now you can see prior to all of that, you can see it was all weakness. And going into 2023, there was a shift in macro analysis, and you can see a shift in delivery, and price went higher. So the ipda, which is interbank price delivery algorithm, ipda has data ranges that it works within, and by going into the market with that understanding, we can have a cleaner understanding of price. Now, an exercise I like you guys to do is, if we talk about algorithm, we're essentially talking about a programming. Okay, it is a program, and what do programs run off of? Programs run off of data. Okay, for a program to run efficiently, it requires data, okay, imputed or referenced to operate efficiently. And the interbank price delivery algorithm is no different from a programming language or a program. Okay, it requires data, and that's what we discussed on module 1. I think the first 2 videos of module 1 we talked about institutional reference points, and I talked about how that applies to all time frames, be it a 15-second time frame, 1 second time frame, all the way up into a yearly range or a monthly time frame. It all applies. Those are reference points that ipda will seek within a time window. So our discussion of the data ranges is simply a range of time, okay, on the macro perspective, that the algorithm will seek to reprice to based off of higher time frame or institutional accumulation or distribution. Okay, and that's our concern with this first part of the video. There usually is a 3 to 4 month shift in asset classes, and what we're looking for to understand this shift in delivery is we need to understand what data the algo will be seeking to reprice up into. So the assumption here, which is, again, you can go back into the commentaries, which are all recorded at the time when we're forecasting price to go all the way up here. Okay, it's not gonna up there yet. We're focusing we're talking about price going all the way up here, but we mentioned this as the near-term general liquidity, and then also this one here. All right, so now what you do is you are looking at data ranges, which is what I did, which I did not show on the commentary, okay, because the assumption is a lot of you guys should already know that by now, but just a lot of you guys are new and you're joining, and this is your first time being exposed to institutional trading, so this one's for you guys. Okay, when price is making a new macro delivery, it has to seek daily, weekly, or monthly premium or discount arrays. Okay, and it's going to do so within a specific time window, and we call that the 20, 40, and 60-day ipda data ranges. Now I know this is it might sound complex to you guys initially, but we're gonna go deeper into that at the later portion of this video. So we have a lot to cover in this first video for today. At this quarterly shift, factor in the market direction, and what a lot of people do is they tend to switch market biases so quickly. Okay, they're very, very quick to switch market biases. All right, if you look at the daily time frame, price tends to stay in place for a very long period of time. So if you look at from February 2022, we stayed bearish all the way down into 27th of September. Okay, and prior to February 22, you can see we also stayed there from May 21st all the way down into January of 2022, May 21st of 2021, all the way down to January 2022. So what that indicates with the macro perspective is macro long term, they tend to stay in place for months. Okay, they're not like the lower time frame that's quick to change, and that's why your analysis always needs to start from the higher time frame analysis, because it gives you the perspective of where the longer term general liquidity is resting at. Okay, now what we're going to talk about next before I go into the 20, 40, 6-day ipda data ranges, which is going to be a little part of the video, is we're going to talk about smart money accumulation for buy programs. So get rid of all of this, squish this a little bit lower. Now this is where I'll consult you to go and this is where I will advise you to go and consult your lesson on market maker models. I think I discussed that on lesson 2 of the introduction to the social concept, which is module 1 of our course. So right around lesson 2/3, we talked about market maker model and the buy program and sell program and their hedging program. We talked about all of that. So now we're going to talk about smart money accumulation for buy programs. So this essentially is, how do you define professional accumulation in a buy? So a buy program essentially is a bullish delivery price on a time frame basis. Okay, so smart money accumulation or by programs. Now, when it comes to identifying institutional accumulation, which is what we call professional accumulation, we want to identify manipulation in underlying versus benchmark. Okay, it's going to make sense shortly. So let's talk about manipulation in the underlying versus the benchmark. And this is why I was a little bit slow to do this video, because there's going to be a lot of boring stuff. Okay, I'm going to be honest. The time frame module, time frame series, it's the most boring part of everything. It's the most boring part of the entire course. The last one I did, actually, a lot of people complained about the length of the course, of the videos, and how it was just boring stuff. And honestly, when I was going through all of this, it was extremely boring to me. But this is one of the ones that you're going to have to probably watch a couple times or pull through. I'm not in the mood to crack jokes to lighten up the mood, to make it more interesting for you guys to watch. But or maybe I should wait until I feel good enough to crack jokes to make it more interesting. But so let's define what an underlying is, and let's define what a benchmark is. An underlying asset is the asset you are currently trading. So if you're trading USD CAD, looking for a setup on USD CAD, that is the underlying asset. Okay, if you wanted to look for a trade on euro dollar, so right now we are on euro dollar daily time frame. This would be our underlying. Now, what is the benchmark? Let's define what a benchmark is. The benchmark is the asset you are measuring the potential manipulation at which the underlying is related to. That simply means, or just something I like to call a reference asset. So the benchmark is going to be the asset in which you are measuring the potential manipulation or lack thereof against the underlying. Okay, so if you wanted to trade USD CAD, or you wanted to trade euro dollar, so let's use euro dollar because that's what we're on right now. Euro dollar is going to be the underlying asset you're trading, and the benchmark asset you're going to use as reference is going to be dollar. Okay, because you're measuring the strength or weakness or manipulation or lack thereof against dollar, which is the reference asset you're using to measure the strength of delivery on euro dollar, which is the underlying currency you're trading. So in this example, if a benchmark makes a lower low, then the underlying makes a higher low. That's classic. So in this, we're gonna stick with dollar and euro dollar for now until we use other examples. If dollar is making a lower low in price, okay, and then runs higher at a discount, then euro dollar has to make a higher high in price at a premium, okay, at its own respective premium, to then run lower. Okay, so this is gonna be dollar, and this is gonna be fiber or euro dollar. Okay, this is the benchmark, and this is on the line. Why is this on the line? Because that's the asset you're trading. So the asset you are trading, or you're looking for a move on, that is the underlying asset, and the asset you're referencing to measure manipulation or lack thereof is what we'll call the benchmark. So in this example, between dollar and euro dollar, because euro dollar is one you're trading, euro dollar is the underlying asset, and dollar is the benchmark. So if we see the benchmark, because you're oppositely correlated, if we see the benchmark making a lower low in price, then we want to see the underlying make a higher high Or if we're trading USD CAD in this example, then we would want to see the underlying make a higher low. Okay, so let's do this real quick. Oh, sorry, a lower low, excuse me. Okay, because it is USD CAD and it is positively correlated against dollar. This is what we'll like to see as a classic correlation. But when we are measuring underlying versus benchmark, if dollar is running lower, then we don't want to see USD CAD run lower. We want to see USD CAD run higher on the underlying asset we are trading. What does this indicate on this asset? It indicates there's an underlying professional accumulation down here. You can remember, not just any random, we're not just comparing every random swing highs and swing lows. Okay, we're looking for these to occur at key institutional levels, and that's what separates, this what we call divergence versus just any random higher high or lower low in price. Because what a lot of students from the past course they tend to do was they tended to go into the marketplace and looking for every swing guy or swing low to have a divergence, and that's how you utilize this concept. You don't just go into every swing guy and every swing low looking for a divergence in price. Okay, that's to occur at an institutional level, otherwise it is null and invalid. Remember, this is just simply a confirmation of institutional participation. It is not an analysis in and of itself. And from there, this indicates an accumulation program for the underlying, just as we have an accumulation program for dollar. So if we see USD CAD running higher at an higher time from discount or institutional discount array, okay, then we know that this run lower on dollar is not a breaking structure. Instead, that is a false breaking structure, and we should see the market start to aggressively run higher. Now, if we see the benchmark making a higher high in price, for example, then we want to see the underlying in the benchmark in this example is dollar. Say we see dollar making higher new highs, okay, runs higher. That indicates strength on dollar. What we want to see is we want to see the underlying, okay, also make lower highs. And in this case, that's going to be cable. Or if we're using USD CAD, so I think we should just stick with USD CAD because me mentioning different asset is a little bit confusing. So if we see dollar making higher highs in price as the benchmark, and let's just define this. So I'm going to stick with USD CAD for now, so you guys don't get confused by me just saying different assets. Okay, so if dollar is running higher and running higher and running higher and running higher, and we see our underlying that we're looking for a trade idea from, if we see our underlying running lower initially, okay, then we can know that this run lower should be a buy. Or if it happens to run below the short-term low here, if it happens to run below the short-term low here, we don't go and say this asset is weak. What we're looking for is we're looking for strength. So now what a lot of people would tend to do is they would go and try to short this, because classic market structure advocates, they say this is a breaking structure, trend is clearly bearish, this is a return back up into a premium, and the market should trade lower. But that's false. Okay, the market should trade higher. Why? Because while we were running lower on our underlying, our benchmark was running higher. Okay, so we had higher prices against our benchmark. So that already indicates that our benchmark has strength. Now look at the pair we're trading, which is USD CAD. It is supposed to be correlated against dollar because dollar is our code currency. Okay, that's our base currency, not code currency. our base pair is dollar. So if dollar is trading higher, eventually USD CAD has to get in sync with that bullishness in dollars. So if we see USD CAD run lower and then we see price trade back up into premium after running a intermediate term low, we don't go and say that's a continuation lower, because we already have a clue from the benchmark that we're seeing higher prices. So this run lower was simply a run down into discount to accumulate sell stops and then switch or reverse the delivery price entirely into bullishness. So this is going to be, again, another form of smart money accumulation for buy programs. Okay, so this is classic smart money accumulation for the buy program. Now let us compare smart money accumulation for sell program. So we're going to get rid of all of this, and it's going to be really important because when we get into the relative strength part of the higher time frame course, this would have built up your knowledge to a basic understanding, and then we can use that to then further delve into more advanced concepts with relative strength. Okay, so smart money accumulation for sell programs is what we're going to discuss next. So in this example, if our benchmark, we're going to stick with USD CAD. If our benchmark makes a higher high, benchmark on the line, and here it has to remain dollar, and here it has to remain USD CAD. If our benchmark makes a higher high and our on the line, which is the pair we're looking to trade, makes a lower high, that indicates that the run higher on dollar is false, and we should see it be followed with an aggressive decline lower. Now, in the previous example, the same way you can use your benchmark to measure smart money distribution. This is not supposed to be accumulation, this is supposed to be distribution. So smart money distribution. All right, so the same way we use the benchmark to measure the smart money accumulation on a buy program, we can also use the on the line to measure smart money distribution on a sell program, and same for a buy program also. So if dollar is running higher, USD CAD classically is supposed to run higher, but if it's failing to run higher, that indicates that the run higher in dollar should follow through with a sell, because we are seeing disparity between the highs between our benchmark and our on the line. So that is smart money distribution for a sell program. We're going to do a more complex example, and we're going to use dollar, and in this next example we're going to go a little bit more complex and use cable. Okay, so now on this one we're not using USD CAD, we're using cable, and you can see what I mentioned about this being potentially boring, and it is, but again, you're going to have to really pay attention to what I'm saying, so it makes sense. You really need to pay attention to what I'm saying. Okay, all right, so if if cable is running higher, so let's just do so. And USD CAD is running higher, you can see here the first leg lower follows through with higher prices on cable, and then the retracement follows with the retracement on cable, classic correlation, and then the run lower follows through with another leg higher on cable, classic, and then we have a breaking structure on dollar, follows through with a retracement, but that does not break structure on cable, and then it follows through with another leg higher on dollar. Then this run higher, we can view this as a run on buy stop. Typically this will be when prices are running for a premium, an high time from premium, where it will then shift delivery. Okay, so this run higher on cable should be a Terra sub sell. Okay, Terra sub sell simply means a stop on. So this would have been a run on a short term high, stop that one out, and see displacement lower. Okay, the reason being that we're seeing a shift in delivery on dollar, and it's delivering higher prices. So if dollar is delivering higher prices, it's not going to allow for cable to continue to deliver higher prices. So we know that any prices higher in cable is just simply a run to build in short positions to then distribute against all the individuals who are chasing the long. So if cables are on the line and we're seeing cable make or press higher while dollar is also pressing higher, then the correlation is going to have to eventually shift, and it's going to happen in cable, where cable then makes the run lower to get in sync with dollar, because dollar is a benchmark. So hopefully that was a little bit easy to understand. So what I'm going to do here, just to reinforce the concept, is I'm going to do a quick summary of all the things we've talked about so it makes sense. Now we're going to go first off into smart money accumulation for buy programs. All right. So we have benchmark is here on the left. Underline is here on the right. Okay, so let's start off. First off, we're looking at dollar, and we're comparing dollar to USD CHF, which is our on the line. If dollar is making lower lows and USD CHF is making higher lows, then we have underlying strength on our underlying asset, which is CHF, and this should really skyrocket because dollar is going to have to catch up to our underlying, because dollar cannot keep trading lower if our underlying is trading higher. So eventually dollar has to catch up and has to trade softly against our underlying, which says CHF, which has relative strength. So relative strength is behind. And when we get into the lesson on relative strength, we're going to talk about leadership versus sympathetic in terms of comparing asset classes. Okay, dollar has to catch up with USD CHF because USD CHF is now trading higher, so dollar cannot continue to trade lower if USD CHF is trading higher. So here we view this run lower as a run of stop, and then we don't view this as a retracement back up into an old low to continue short, but instead we look for reasons why prices shift delivery. And the moment this happens, that's a shift in market structure, and now you're bullish. We're going to go into example number 2 just to reinforce the concept of benchmark versus underlying and understanding the manipulation among both, and this is for smart money accumulation for buy programs. here we have dollar on the left, and on the right we have USD CHF. So we're going to get rid of the previous annotations and use a new one for today. Alright, so if dollar is okay, if dollar is trading lower, okay, then euro dollar is also trading lower. The run on the lows is a torso. Now we're looking for bullishness, because we cannot have the benchmark and on the line trade the same for an extended period of time. Okay, when I say eventually give, and oftentimes it's going to be the underlying. Okay, so dollar, which is benchmark, if it's trading lower, your dollar cannot continue to trade lower. If dollar is trading lower, that's eventually give and switch structure and go higher. So once you see it run lower and you see a shift in structure, that's your cue to go long. And number 3, the final example, and I know it's extremely boring today. If we see dollar running higher in price, so let me just throw this out before I actually do the annotations. If dollar is running higher and your dollar is also running higher, which has to give? But that's what happened eventually. Euro dollar will continue to run higher, and dollar has to give as torso and run lower. Okay, so here we have dollar running higher, then we have euro dollar running higher. Dollar cannot continue to run higher if euro dollar is running higher, so that's a give and trade softly against euro. Alright, and then this would be a run on buy stop, and here will be a retracement back up into a premium, and we'll have this shift in structure here and continuation of order flow. So hopefully that sums up benchmark versus underlying, and you understood what I said, or what I was postulating with the concept. And now we're gonna go back to our ipda data ranges. And here we're primarily going to focus on the 20, 40, and 60-day ranges. Now, if you went back, or if you're following what I was stating on the first part of the video, I mentioned that ipda is an algorithm. It stands for interbank price delivery algorithm, and just like any program, it requires data, okay, for function. And with the 24-day, 6-day ranges, what we're looking for is we're looking at what we call a look back. Okay, so look back essentially is we're looking behind current market price action for institutional reference points that should be salient in terms of price drawing up into them. So they should be targets for current market price action, because the algo is going to reference them for function, since they are data sets. Okay, and I know I'm going slightly into like math or something, but it should make sense. Okay, so with the ipda data ranges, the first thing we're concerned with is what we call the look back period. Okay, we're concerned with the look back period. Now, this is how you can utilize the look back period. I'm going to use a live price action example to delineate what I mean by the look back period. So with the look back period, you're going to delineate your chart from the beginning of the most recent complete calendar month. So if you are trading in the month of October, the most recent complete calendar month before October is September. Currently it is April, and if you're trading the month of April is not complete yet. The most recent complete calendar month is March. Okay, so your look back period starts from March, and you're looking back from March to identify your data sets. What are your data sets? Your data sets are going to be your institution reference points, something we discussed on lesson 1 and 2 of the first module of the course. Okay, those are your data sets. So you want to look at institution reference points as data sets for your analysis. Okay, so what you're doing is you're looking at the most recent complete calendar month to see where price action is, and then you're looking back to the left of your screen in terms of 60 days, 40 days, and then 20 days. Or you could do 20 days, 40 days, and then 60 days. But we are using a revolving 60-day range from our current price action for our data sets to identify our reference points and seek where the most likely drawn liquidity is going to be. Now, what you do next after identifying your data sets within a period of 20 days, you delineate the data set within a 20-day period. We call this the look back period. And then you delineate your data sets within a 40-day look back period. And then you delineate your data set within a 60-day look back period. So you refer to recent institution reference points between the delineation. So for example, it could be, if you're bullish in price, you can look for old highs and look for a bearish order block. But you need to make sure that you're identifying your data sets proper. So in that old high, you have a rejection block there, and then you have old high, and then you have probably bearish value gap. Okay, and you are simply just identifying, in case you're bullish, you're identifying primary rays within the 20-day data set, 40-day data set, and then 60-day data set, and you're looking at them as draws on liquidity from current market price action. And what you want to do next is you want to anchor your vertical line to the previous market shift, meaning where can you identify a quarterly shift, just like I showed you guys. Okay, remember, a quarterly shift usually is 3 or 4 months. You're looking for what you think a quarterly shift would be, and then you're anticipating price action forward to trade up into those data sets. Alright, so let me show you this in practice, because it's all theory right now. And we're going to do all of this in practice, and we're going to use Euro dollar. And I'm going to go back to the previous example, which is from the month of October. So we're going to use this because this is something we've been through, and this is something we anticipate in price. Okay, so as soon as we see displacement higher on euro dollar, okay, we're anticipating that there should be some form of bullishness in price. Now you can see euro trades up into a premium, it's run lower, so we have bearishness in euro. Now what we want to see is if that bearishness is confirmed with bullishness on dollar. Okay, so euro dollar makes a lower high in price, and dollar makes a higher low in price. So far it's still very bearish for euro. Okay, now we're already anticipating quarterly shifts using all the other tools and concepts, which we'll talk more on further videos in the course. We have a bullish order block here, so we're going to identify that bullish order block. If we want to be bullish, then we want to see discount rates hold price, and want to see primary rates give way in price. So and then we trade down there. Okay, and the anticipations, we're looking for a bounce. We've not confirmed order flow yet, and you can see we have a swing which is formed. We have a premium array up here. If we want to be bullish, then we want to see price trade through the premium array. Okay, and that will confirm that we have potentially a quarterly shift down here. Okay, and again we can compare against dollar to what dollar's doing, which is a reference currency, and dollar is trading with a lower high, just like you're trading with a higher low. Now let's compare with another correlated asset, which is going to be cable, pound US dollar. You can see we have very clean delivery amongst them. Awesome. And now we've seen price trade through our fair value gap, which does not hold price at all. Okay, and this becomes a propulsion candle. Now, with the look back period, the most complete month from our current month of trading is September. So we start from September and look back. Okay, so October starts here, and we're gonna go back. Let's see. So you use your date range tool in Trend View. The most complete month is September. So 20 days from the end of September is this. 40 days from the end of September is this. And 60 days from the end of September is this. Now, if you went back to my videos where I was calling for this as the liquidity objective, and this is something I was doing as part of my analysis, which was not being discussed on the commentaries, but you would have seen that we were calling up here because that is the liquidity within a 60-day ipda data range. Again, we're looking for data sets within a look back period: 60 days, 40 days, 20 days. So the nearest liquidity within the 20-day data set is this eye here. So any bullishness short term or intermediate term, we're going to be targeting the liquidity up here. Now, within the 40-day data set, which starts from here, we have a rejection block and then a swing high. So those should be draws on liquidity intermediate term. Alright, so let's see. And we trade down into the fair value gap as an inversion. Okay, I want to see price displace away from there. Trades down to the fair value gap as an inversion, comes back into propulsion candle. What do you want to see? Do you want to see price displace or not? You're not sure, but we are making higher lows. So if you want to confirm delivery, we need to see price make higher highs in price. Okay, now it looks like it is bearish because we're making a short term high, and we trade through back up. And you can see we use that same old fair value gap as an inversion again. Now let's compare this low here. We have a higher low on euro. Can we compare that with a lower high on dollar? Is dollar making a lower high? So this low here to this low here was higher in euro. Then we have another higher low in euro. So if you're wondering how I know this, I'm using the closes, the close of the candles to identify the swing. So let me just show you the candlestick close. I can see if I pull up a line chart on euro, you can see this low here is higher. If this low here is higher at a institutional discount, shouldn't dollar be lower? But dollar is not lower. Dollar is going higher. Okay, you can see this run higher is higher than this short-term low there. So we have a disparity between the benchmark and the underlying. Because if the benchmark is running higher, underlying has to run lower. Okay, but now benchmark is running higher. Benchmark is running higher, underlying fails to run lower. That's a disparity at an institutional level. That confirms that dollar should eventually give and get in sync with strength on euro dollar. So euro dollar here is your leadership asset. Okay, so let's go back and use our candles. And now we are looking for bullishness. So we have a bullish order block here. And we want to see expansion away from the bullish order block. You can see expansion up. And where is the first round liquidity? We're aiming for the 20-day look back. And you can see price trades up into 20-day look back. And after we trade up into 20-day look back, is there any premium within the 20-day look back that price needs to reference? Just none. So because there's no premium within 20-day look back that price needs to reference, we go out to the 40-day look back. That's the next data set in terms of a draw on liquidity that the algorithm needs to draw up into. Okay, but now if you look here, we have a series of up candles prior to run lower, which are all bullish order blocks. The moment we trade above them, they become a mitigation block. So we could potentially use our mitigation block as a launching pad into our 40-day look back. You can see price trades down there. We have a fair value gap here inside our mitigation block. Trades down into a fair value gap and back into an old bullish order block. Does this mean we're now bearish? Let's see. If euro dollar is running higher, then dollar has to be running lower for positive correlation. So let's compare. Dollar is running lower, while euro dollar is running higher. So this is a healthy sponsorship of delivery. So again, that does not mean we go in and look for shorts because we've seen price run lower. There's no reason to go in and look for shorts if dollar is showing a healthy sponsorship with euro dollar. Okay, so now we've seen a little bit of a pop, but we're back up into OB a bearish order block. And we're still inside the candle. We've not lost this bullish order block yet, which is a discount. Okay, we've not lost the bullish order block yet. And now we have lost the bullish order block. So now, are we bearish? Well, let's compare. Dollar is running lower. If dollar is running lower, we want to see if euro dollar is running lower. If euro dollar is running lower, we want to see dollar run higher. So this is lower comparing. Okay, euro dollar is running lower, we want to see dollar run higher. So let's use a replay tool next. And guess what? Euro dollar ran lower, but dollar is not running higher. Again, let me show you what I mean. I'm looking at the closes. I'm not looking at the wicks of the candle. So if I use the line chart on euro dollar, you can see clearly it's making a lower low, while dollar is making a lower high. Okay, there is disparity. There is disparity between dollar and euro, because if dollar is running lower, euro is not supposed to go lower, but euro is doing so at a discount. What does that mean? One has to give. Okay, If dollar is failing to run higher, that shows dollar is still very weak. Okay, so if dollar is very weak, then that run lower on euro dollar should not be followed through with bearishness. Instead, that should be viewed upon as a run on stops to then run higher. So let's go back and look at our candles. And what next? We traded higher in price, and we have 1, 2, 3, 4 down candles. If we can get a close above all of these down candles, then that's a bullshit block to view long term. Okay, we're back inside the mitigation block again. Again, we don't just discard the mitigation block because we run lower into a discount. What discount would that be? That's gonna be the last down candle prior to all the run higher. That's a bullshit block. That's what we're trading down into. Okay, now we're inside the breaker block. Last up candle prior to run on sell stop. It's a breaker block. We're gonna see displacing away from there. So I have a breaker block inside the mitigation block. So this takes precedence. Okay, because that's our immediate PD array. Now we're in a new month, the month of November here. So again, we do the same thing 20 days back. $40 days back. And then 60 days back. Now, our journal liquidity in the 40-day look back, 20-day premium is higher than that of the 40-day premium. So we're not really interested in the 40-day look back. But our journal liquidity is up here on the 60-day look back. So we know that price at minimum has to trade above the rejection block and then the short-term high. We have a down candle in a run, in a bullish delivery, so that should follow up. That should follow through with bullishness in price, and you can see from our breaker block, price trades down into the discount low of our breaker block and aggressively runs for the buy stop. And this is how you use the data sets from the 20-day period, 4-day period, and 6-day period for your higher time frame draws on liquidity. Okay, so let's get rid of all of this. And now the question is, what happens after you've exhausted your data sets? Then you go outside your 60-day data set and look for the next premium if you are bullish. So what is outside our 60-day data set? That's this eye up here. So we know that should be the journal liquidity in price, and there you go. Okay, so you don't necessarily have to confine yourself to only the 20-day, 4-day, or 60-day data set, but what they do is they assist with the quarterly shifts. Okay, again, remember, quarterly shifts is 3 to 6 month period. 3 to 4 month period is your quarterly shift, and by using your data sets, you can easily use that to identify where your daily draws on liquidity is or are. And just to now, what you can do with the look back is you can use what I call the first one. You're looking for the start of the most complete month for your look back. And again, you don't necessarily need to have them on your chart. And this is just a teaching, and this is sometimes you get caught up with 2018. So what 2018, when I was learning all these things, I used to get caught up with the look back and there's something called the cast forward. So cast forward simply means you, from your delineation of your look back, you cast forward again 20 days, 40 days, 60 days, and anticipating the market to run into your look back within those trading periods. Now, all they do is they aid you in identifying your data sets. You would never see me on my chart use the look back. That's why I don't do that in my analysis, because you're not necessary. Okay, you don't see me in my analysis use the look back of 20 days, 40 days, 60 days for data sets to know where price is going to drop into. All I need to know is I need to know what the delivery is. Are we in a market maker buy program or sell program? That's what I need to define. Once I can define the market maker buy program or sell program, I automatically know where the drills on liquidity are by identifying what premium rate we're looking for. So I don't need to use look back, but the look back can help you bring into focus the important data sets that you should be anticipating as drawers on liquidity. That's all look back does. Now we use something called the not revolving, I think it's more like a current look back period. So that means where the current market price action is. So in this example, that is this, and this is how you use the look back period. So usually if you want to use the look back period and you're starting out, you want to use the most complete month for your data sets, but you can also go a second route, which is from your current market price action. Okay, so this is current market price action from our replay tool right now. We go 20 days to identify our premium versus discount. If we're bullish, we're looking for discount rates to buy from. And we're looking for premium rates to as draws on liquidity. And 60 days. Okay, so within our 60-day period, this is the highest we've ever been. If that's the highest we've ever been, okay, where is our discount? Within our 20-day look back, we have a fair value gap here. And then we have another fair value gap down here. Now outside the 60-day look back, we have no premium, or inside the 60-day look back, we have no premium because this is the highest we've been in a while. So meaning we have to go outside our 60-day look back, and that's going to be up here, and that becomes target liquidity draw. That is our target draw on liquidity, and this is our discount array for bullishness. Now we don't want to see price return back down into the breaker block. Why? Because price has done so here. We've seen expansion away from the breaker block, so we don't want to see price return back down into the range. So this is more likely to see expansion in price, because you can, if you look to your left, just a breaker block, 1, 2, 34 candles prior to all the run lower to take out the sell stops here. That's also a breaker block. So we're more likely to see expansion away from here, especially seeing price trade down into the breaker block, which is why we're not delineating that here, since we have an immediate draw on liquidity up here. Okay, so within our look back period, don't go like this. Again, it's moving. So every single day you move your look back period. Again, you move it, move it, move it, move it. You do the same thing again. So I'm showing you how you would utilize the look back period from current market price action. And we're inside our discount. I'm seeing bullishness higher away from our fair value gap inside our 20-day look back. I can see you're constantly moving, so it's a dynamic look back. Okay, it is a dynamic look back. Now you can see all I'm doing here is I'm just moving the ring data set, and by moving the data set brings into focus what my concern should be. Okay, so within the 20-day data set, my concern is this fair value gap and this fair value gap down here. Within the 40-day data set, my concern is nothing, except probably the breaker block, but we don't see pressure down to the breaker block because we've seen expansion away from there. Within the 60-day data set, we don't have any concern because current market price action is far away from the 60-day data set and also the 40-day data set. So they're not of concern to us. Only the 20-day data set is of concern to us because that's a discount, which is the expansion from. And outside our data set, we have a liquidity up here for a longer term trend liquidity. And let me just use a replay tool because you understand what I'm saying. Okay, and you can see eventually we get up there. Okay, so every single new day you move your data sets, and you do that for the 20-day data set, 4-day data set, and then 60-day data set. If you're asking what the importance of this lesson is, it simply is to draw your attention to where the drills on liquidity is, or where your data sets for expansion in alignment with current programs. So in this program, we have a buy program, so we're looking for a discount in our 20, 40, 60-day data set relative to current market price action. So you can use a dynamic moving data set for your analysis versus the other one where you have to wait for a complete month to start your identification of data sets to look for PD arrays as the drills on liquidity, or as the drill on liquidity. I know it's a little bit boring, and we've almost gotten into over an hour of content, and I talked about this before. That's I was a little bit slow to do this lesson. And what I will do is I will follow through tonight with another video. So I was supposed to do 2 videos today, but because this is so long and it's going to take a long time to watch this, I'll follow through tonight with a forecast of current market price action. So currently we are in the month of April, and it is April 23rd. So tonight you're going to get 2 videos. One video is going to be an evening commentary, and then the other one is going to be just an higher time frame analysis using what I just discussed in today's video, so you see how I use that in person for a forecast. Alright, so you guys will have an awesome day, and I will talk to you guys later this evening. Trade safe.